So I'm sitting here thinking to myself, would it be possible to actually take this screenshot that I took of the S&P 500, otherwise known as SPY, on the 1-minute chart from TradingView and actually use Claude Code in order to come up with an algo strat for this, right? So for those that want to find out, go ahead and stick around and go ahead and smash that like and subscribe button. What's happening, everybody? It's your boy Creative. Go ahead, say it with me. We are back at it again to do what? To create something great. Now, I'm not going to hold you. I'm super excited what I had planned for y'all today. And this was during a session on from April the 17th, 2026. I seen this clean bear setup, right? Indicated by these red candles here. And I seen this clean bull setup indicated by these green candles here. And I was thinking to myself, I can't let this go to waste, right? So we can see here that the bear cleanly went through this support line, and the support line is going to be the lowest low that the underlying asset or the underlying price that the asset moved to, and the resistance line is going to be the highest highs, right? So we've seen it here that it cleanly went through the resistance line, support line, and it's trying to find its way back to the new resistance line, right? So what I wanted to do is say, all right, you know what, I don't want to lose this strat, so I want to use Claude Code in order to create one. So we did come up with one, and that strat is called GotEyes. So this strategy is going to be using price. This strategy is going to be using volume. This strategy is going to be using support and resistance, right? So it's going to be our PVSA strategy, right? So this strategy is going to be trading from 9:45 a.m. to 11:37 a.m. EST. This strategy only has 3 trades per day, and 3 minutes is directly targeted to theta. Now remember, theta is going to be for every minute that we're holding this option contract, we're going to be losing money, right? So this 3 minutes directly targeted towards theta. So we're either going to work or we're going to get out, right? I want to preserve the capital and go deploy elsewhere. And the position sizing is going to be tiered based off of VIX. VIX is going to be the volatility index, right? That is going to or our fear index. This is what the market expects to happen within the next 30 days, right? So we're going to do our position sizing that is going to be tiered, and it's also going to be VIX aware, right? So volatility aware, right? So this is how GotEyes work and how we are able to say, okay, you know what, how do we actually take a trade, right? So step one, we have to establish our support and resistance zones, right? So I wanted to see if I have a chart for it. I did, but I can't find it. Let's just keep going. So the first one is going to establish our support and resistance zone. Now remember, support is going to be the lowest low that the underlying asset touched, underlying price that the asset went to, and the resistance is going to be the high that the underlying asset went to, right? So we can see it here. Our support is going to be indicated here by this green line, and then our resistance is going to be indicated here by this yellow line, right? So whenever we see a price touching the resistance, I keep doing that, I apologize. Whenever we see the line touching the support line, right, what normally happens is that is also predicated by a bounce, right? So we see it touched, all right, it bounced. So whenever we see an asset touch the resistance line, that sometimes, not all the times, right, because there's no like crystal ball guarantee with this thing, what we normally see is that it's going to bounce off of it, right, because normally rejected it, right? So what we're looking is to be able to establish our support or resistance line. We're doing that with a rolling 15-minute or 15-bar support and resistance, right? And we have a stock high with 0.44 as the threshold, right? And that'll make a little bit more sense once we actually run the back test, right? I'm doing resistance for puts and we're doing support for calls. So think of it like this: the price is testing the ceiling, that's going to be the resistance, or the floor, that's going to be the support, built from the last 15 minutes or bars, right? And here's how the code works. Step two, what we're looking for is the strong candle body, right? So what we want to see is the touch candle must show conviction, not indecision. So indecision is when we see these wicks here, right? Whenever you see a wick, you're seeing a lot of indecision. So what that means is that, all right, the bears tried to push the price down, but they didn't have that much conviction here, right? So I see some indecision, and we also see some indecision here. We see some indecision here, right? Whenever we see a wick coming out of a candle right? With a small candle, that's letting me know that's indecision. So what we're doing with this particular strategy is like, all right, I want a candle that shows conviction. So the body must be 60% of the candle range. If that is so, we're going to go. So think of it like this: a strong close equals we have institutional conviction. Dojis or small bodies equals uncertainties, and this is not what we want. And then we're also going to be looking for volume, right? So volume must be above the baseline, and that's when we're using the EWM, right? Average of 8, and that 8 is going to be the last 8. It must be higher than the baseline, right? So think of it like this: big volume at support and resistance equals money stepping in. Low volume touches are just noise. And then step 4 is we're going to check the support and resistance, right? There must be room in the support and resistance. If there's not room, then how are we going to actually take the trade, right? So too narrow equals a choppy zone. No room equals is going to revert. Excuse me. We need the space so that mean reversion is going to actually play out, right? So what mean reversion is that we're seeing that the price is being tested at exhaustion levels, right? And those levels could be the resistance line indicated here by this yellow line, or the support line indicated here by this green line. So whenever we see that the key levels are hit and volume confirms that, the move stalls out. What we're doing is that we're creating a strategy that fades it using 0 DTE options, right? 0 DTE is going to be option contracts that expire the same day. So all 4 are green. Now we're going to jump into the trade. So let's actually go look at the back test, bruv, right? So I spent some time just being able to go over it. So this doc string, just go over it a little bit more, right? So this is going to be a mean reversion strategy. So think about it this way: whenever we see a move happen, right? Whenever we see a bearish move happen, right? We're going to say, okay, you know what? We see this bearish move happen. This bearish move went ahead and crashed through the support line. We're going to bet that it's going to climb right back up. And it did here, right? But we also see this major climb right here that we're able to predicate off of this particular move, right? And the inverse can happen whenever we see the price right here, and we can see it right here, right? Whenever we see the price crash through the resistance, we're going to see normally what happens is also precipitated by a pullback, right? So we're just going to say, all right, it crashed through. Now let's look for our pullback. We're going to look for our pullback. The pullback sustained here, and this is what the strategy is looking for. So we're looking for price. We're looking for volume, right? We're looking to make sure that it's touching our levels, and our levels is going to be our resistance, and this indicated by here. This is going to be the highest highs, or indicated by support, which is going to be the lowest lows, right? Remember, our strat only trades between 9:45 and 11:44. It's supposed to be 3 trades, not 1. So we can go ahead and update that. Right, option selection, how we select options. This is our min and max. So once we actually get a signal, right, the next thing to figure out is how we're going to select options. The way that we're going to select options, we're using a delta min and max between 0.2 and 0.55. Reason being so is because this controls the moneyness, right? What do I mean by that? Is these are going to be option contracts that are at the money, out the money, or in the money, right? So we want a little bit of a combination of both. And we're saying here that your minimum that you can spend on this algo is $25, and the maximum is going to be $115. Now, unless I tell you otherwise, right? And remember, this is not financial advice. If you do seek financial advice, please make sure you talk to a certified financial planner. This is merely educational. But all right, unless I tell you otherwise, all of our algos, right, are going to start with $100, because we want to be able to take away the notion, or dispel the notion, excuse me, that we need thousands of dollars in order to algo trade. That's not the case, right? So what we want to show is like, all right, bet that's not the case. Now let's show a couple of different strategies that's been doing that. And that's been my name of the game, right? Being able to start at $100 and see how we can get a strategy to be able to start at 100 and be able to move from there, right? So these are our different milestones that we're looking at. We talked about our sessions. We already talked about how we get our support or resistance. This is our signal condition, right? This is our option selection. The exit rules is the only thing we didn't cover yet, right? We're looking for 15%. If I can't get 15%, you have a 20% stop loss. What this means is that if the move goes against us, right, if we're down 20%, get me out. Now, I want to give it a little bit more wiggle room because to be able to account for intraday noise, because sometimes what looks like it's something that goes against you really doesn't, right? So that's why we're capping at 20%, and it has 3 minutes in order to do this, right? 3 minutes to make 15%, 3 minutes to figure out if the move is going against us, right? And this trail stop loss, what this means is that if we're up 8%, lock me in at 8%, right? And then if I go down 2% from the 8%, I need you to get me out, right? Because one thing that I always say is you never go broke doing what? Taking a profit, fam. So if I'm 6%, is better than negative 20% all day, right? So we want to be able just to keep compounding, right? So this is our VIX range. We already talked about VIX. This is our volatility index and slippage. The biggest thing with slippage is you want to model that in your back test, bro. If you're not modeling slippage in your back test, then you're just lying to yourself, right? So slippage is the difference between what you think you're going to pay and what you actually pay, right? So in other words, when you actually submit your order, right, that is going to be what you request, what you actually get filled with, right? So for an example, let's say we submit an order for $100, but what we actually get filled for 110, that $10 is going to be slippage, right? I know, bruh. I like to call it just taxes for playing the game, right? But slippage is always going to be there, right? So you just got to be able to account for that. We have our fill probability. That's basically letting us know is that, hey, not every order that we submit is going to fill. So we want to be able to work that in here. And then we also have our fee. So I feel like I've talked enough about this. Let's go ahead and run our back test, bruv, so we can see the results from it. So I'm going to run it on 2024. I like to start all of our back tests on 2024 so we can see the results from it. And 2024 is going to be a bull year, right? So bull year, meaning if you dropped a $5 in the market, I mean, I'm just being facetious at this point, but it doesn't matter, right? Like you would have done very, very well in 2024 because that was a bull year. And we're also going to run the inverse 2022, right? Because I want to compare them against each other. How do we do in a bear year, right? How do we do in a bull year? 2022 is going to be that bear year. 24 is going to be that bull year. So I'm running my back test. Now remember, this back test is going to be a vectorized back test because there we go, and it's sliding. Right, vectorized backtest and an event-driven backtest, and we talked about that in our backtest episode 1. So if you want to see that, I'll go ahead and drop the link in the description. So for us to review it, right, and I know it gets ridiculous, fam. It gets ridiculous, right? Remember where we started. I took this pick, I dropped it in Cloud Code. I was like, bruv, you see what I see? Right? That's why it's called GotEyes, right? We're able to go from $100, right? 698 trades, and it looks ridiculous. $400,000, bruv. 400K, right? 82% win streak. 82% win rate. Average win was $97. Profit factor was 15. Max drawdown. And I know this gets stupid. The thing that just alarms me with this one is that I don't trust it. The thing about it, right? Sharpe ratio is just going to let you know, like, what is the unit for every return, right? How much risk did you take for that return, right? So a Sharpe ratio, anything above 2 is hedge fund money, right? That means you're like starting a fund, you're raising money. I'm not doing that at all. This is personal gain, and I'm just giving y'all what I see, right? So that 15 Sharpe ratio is just ridiculous at this point. But again, I just take that with a grain of salt, right? I just look for Sharpe ratios that are above 0.75. If you're above 0.75, you're good for me. Oh, Sharpe ratio range, anything between anything less than 1 is seen as like, all right, what are we doing, right? Anything less than 0.5 is like, all right, what are we doing? Anything between 0.5 and 1.0, you have a good strategy on your hand, and everybody has a different school of thought. This is just my personal opinions, right? Anything above 1.0, then you have a really optimal strategy, right? Meaning for every return and the risk, it makes sense, right? And then for anything above 2.0, these are hedge fund hedge fund money levels, right? So for an example, Warren Buffett, right? I think his average Sharpe ratio, and I think, don't quote me on this, I just would have to like check the numbers. His average Sharpe ratio is like 2-3, bruv, right? So if I'm at 15, this is telling me, all right, just let's keep an eye on that just to make sure we just double check these numbers. So that's why, yeah, it's good, but it's not something that I'm taking it to the bank, right? Because this strategy is actually one that is running, but it's just something I just wanted to preface there, right? So we have our exit analysis. We see here that we over 80% for calls and puts, right? The strategy loves low volatility, high volatility, not that much, right? And it does trade in high volatility, and it is 100%. That's interesting, right? Top 3 trades you see here, $6,000. Top bottom 3 trades, most we lost was $1,300. So let's run this in 2022. Year 2022, and let's see how the strategy performs. So we saw how it performed in a bull year, right? Now we're going to run the inverse, right? We're going to run the opposite, a bear year. I want to see how the strategy performs in a bear year. It's not like I'm waiting for you or anything. Here we go. All right, and you see it's pre-index, bro. So I'm running it on 2022. We already seen 24. 2022, not as much activity, 418. But again, let's look at the important numbers, right? So how many trades? 418 bet. Of those trades, how many did you win? 84%, right? Or 354 trades. Of those 354 trades, how much was your average? $750, right? $749, excuse me. How much did you lose on average? Was $217. Now let's talk about a few things. The max drawdown is 3%. But the strategy felt so bad that every time it lost money, it was bringing us back $19, right? And that's this profit factor. Now, again, Sharpe ratio is double digits. Now, just take that with a grain of salt, bruv. Strategy was able to go from $100 to $500,000, right? $251,000, right? And again, bruv, where did it start? From a picture, right? So I don't want to make this video too long, but as you can see here, the strategy is actually conducive, bruh. So I want to show you how this strategy is actually performing in real market. So that's going to be the next video. So I need y'all to go ahead and like and subscribe, and go ahead and drop in the comments right now. How do you feel about creating a strategy just from an image, right, using Claude Code? So I appreciate y'all. It's your boy Creative. I'll be back at it again with another episode.